Welcome everybody to our monthly webinar with BayFort Capital. We'll discuss global markets, and this time we want to have a special emphasis on valuations because the markets have declined. So we also want to show you how low the valuations are. Sunil will start with the US macro information, what happened in March, and later on I will follow. So let's start with that. Sunil, the floor is you.
Hi, thanks, Ketul, and good morning, everybody. Like Ketul mentioned, we will focus on the US macro because the portfolio is significantly US oriented, and all the action seems to be happening around the theater of war is thousands of miles away, but the theater of the markets is, I think, centered around the US. So first of all, if you look at the war, right, and the key thing is that, as you all know, the Fed's policy has a significant bearing on the equities market. And hence, there was one Fed meeting, which is around the war that happened. And so if you then look at the oil and inflation part, on what it's likely to have an impact on the Fed, the key thing is that Fed doesn't seem historically to think of oil as a permanent thing on which they need to alter their broad philosophies, right? Yes, tactically, in the short run, they might delay a rate cut or do a rate hike or something, but they'll view it as transitory. And the word transitory, I think, right from Mr. Powell's time, it's become a key part of the dictionary, a very, very meaningful word. So the point is that the word transitory means that Fed will make it a part of their commentary, but not lead it into action. That's the way I have interpreted it. And if you look at the data from Apollo that we have shown on the slide, the max spike has been absolutely about 1%, and this is at a shock of $50 per barrel. So this is generally the US, Texas Light, right? So there, if you see right now, it's probably trading around 100, 110, and 60. So 50 is probably the peak in terms of that. At that peak, it's just a 1% spike in the inflation, which rapidly goes away once the situation settles. And it might take you back to the Russia-Ukraine war when oil went to $140. While the war is still continuing, the impact of the oil has been absorbed by the markets, and it's actually stabilized before this new war started. So the key thing is that while oil gets triggered by a war related to oil supply or oil demand, the fact of the matter is it's an immediate sharp spike which impacts the markets. The Fed doesn't treat it as a long-term, and neither in the market practice, it has become a long-term determinant of market valuations. I think that's the main thing, right? So if you look at it, the markets tend to digest this and then stop worrying about it in the future. Wherever oil price ultimately settles, from a Brent perspective at maybe $80, from a Texas Light to maybe about $70. Normally, today is an unusual situation where the Texas Light is always trading higher than the Brent crude, but that's an anomaly. Normally, there is a $5 to $10 gap there. And so I would say, yes, you can then look at it and say that when you look at it, saying that if there is a stock market correction before an event which is not going to last longer, then every such correction becomes a buy point, right, on a broad basis. In this case, it's oil. But whenever you see that the market is getting impacted by things which is not affecting the fundamentals of the economy stroke markets, then market comes back to its next level. So maybe we can move on to the next slide, where right, if you look at the US economy and the assessment of the macro there, obviously the headwind is the sustained oil price, because how long will this continue? Well, that's more of a political decision. But if you look at where gasoline prices at the pump are up 35% since the war began, clearly there's going to be political pressure also to do something to declare victory in a losing war, maybe, or in a war that's not going. But whatever it be, right, it is going to mean that as long as the oil price hike is there, financial conditions will be tight, right? But what is the tailwind? Mr. Trump and his one big beautiful bill and the fiscal policy, which the refunds should flow through in this year, or what he announced last year. And the refund spike is about 20%, which is almost $4,000 per person. This will have a favorable impact on consumer spending, it is anticipated. So that's a tailwind which continues for the economy. On the labor market, we think the 4.4% is broadly a band around which the labor market will do. So it may not be a key determinant of Fed action because, for the Fed, there are these three things, right? Inflation, GDP growth, as well as labor. These are the three factors. We don't expect that to be a fundamental determinant. Yes, I know the data which came yesterday showed a sharper job loss than expected, but it's not something which critically determines the policy as such, because I think the 4.4% is a kind of fulcrum around which it will move plus or minus a few percentage points, right? And we spoke about the huge Capex investments, $650 billion happening by the big 5 or 6 companies. So these investments in AI, that's on the Capex side. But if you look at the user industries, right, we think that the adoption of AI is going to boost productivity, and which will be a corporate catalyst for earnings, right? So to that extent, that's another tailwind, we would say, from an impact of AI on the earnings of companies, right? The next slide, right, comes back to the inflation point, and we wanted to demonstrate that yes, inflation is nowhere near as it was in the early quarters of 2023, right? Since then, it has been on a trajectory down, and since we have a very near-term outlook, for us, the recent spike, looks like it's a big spike, but it's not. In the context of history, we are nowhere close to those peak levels of inflation. And then if you read the text that's there, right, personal consumption, PSC, right, that price index is always projecting for this year from 2.4 to 2.7. Now, we have said that it's notable there, but it's in the context of expecting easing inflation and rate cuts, that it's reversing to rate hike, right? So that's the significant. I think 2.4 to 2.7 in absolute digits is not much, but in terms of the outlook and the sentiment, it is in fact a bearish trend from that perspective, right? So consumer price index as a consequence of this PCE should average about 3.2, but come back to a 2.6 level in 2027, right? So this seasonally adjusted number, right, it's a 28% month-on-month rise, is the price index for gasoline, which I spoke about already. So to that extent, the inflation is severely impacted for the current year by the short-term oil-related spikes primarily, right? So as we move on from this slide now to the employment, which I mentioned was the other thing that the Fed critically looks at. So if you look at the projections here, right, on 2026 GDP growth, all we are saying is that the March 26 projection has gone up by 10 basis points. So the US economy's fears of a recession and all that, I think you have to remember that they are not the top line thing now. There's no growth fears on the US economy. We already spoke about the PCE. And the core PCE will also go up by a similar thing to 2.7. But we expect unemployment levels to remain stable at around the 4.4% levels, right? So that, to that extent, they are not a key determinant of the Fed policy. And like we said, US economy continues to be in a gently expanding mode, right? And Mr. Trump's stricter immigration rules and whatever he tries to now put tariffs through the back door of those two other sections, right, on uncompetitive practices and something which is critically strategically important to US, they will use that to put additional tariffs. There's talks about steel and other things that are happening, pharma, for example. So they will be, they may act as a drag on expansion, just need to be aware. But whatever said and done, chances of recession, which is 2 consecutive quarters of negative GDP growth, are pretty low at this point in time. So overall, employment and GDP growth are not a concern at this point in time in our read. Going forward to the next one, right, is Mr. Wash. Now, we all know that the earthquake, Mr. Wash's appointment cost because his past views were very, very hawkish, right? So the Kevin Hawk Wash was what he was labeled. But if you then look at it, right, so there's no way Mr. Trump would appoint a hawk. So I think that clearly Mr. Hawk was a hawk because of the situation then prevailing. We expect him to be pragmatic about the current situation, and his hearing will come up sometime in the next 2 weeks of April in front of Congress, and we expect him to spell out his policy, which is that it could be a regime change from the previous regime on terms of focus on lowering rates and reducing balance sheet, right? So balance sheet reduction naturally will take time, but we expect that once the oil-related spike and the war-related spike goes away, the Fed should come back on a interest rate cut chart as early as mid-April, we can say, but that's obviously dependent on the war-related situation. With that proviso in mind, keep that in mind, right? So, but the markets, what they are at the point in time, are still now, they went to 0 rate cuts from a 2 rate cut expectation because of the war and probably because of Mr. Walsh's earlier track record. But I think as realistically we come back, once the Middle East conflicts get resolved, I think the situation may be conducive for a rate cut, but this is not being factored yet by the market. So what we are trying to do is read the tea leaves ahead of the curve. Of course, his confirmation hearing, he will spell it out. His first meeting, he will spell it out. So probably it's better to form a clearer view. The market is waiting for that to form a clearer view. But let's bear in mind that because this is a transitory inflation spike with GDP growth fairly stable and unemployment fairly stable, the situation could very well turn conducive for a rate cut, though it's not built in the market expectations as of now. Right. Next slide. Right. And what we've seen, and one which was a big surprise to many, right, is that this geopolitical conflict has not seen the gold spike, has not seen the safe haven gold. Instead, dollar has assumed the safe haven. Now you will think about why that is. Well, it's clearly that the dollar versus gold, simple. It is an income earning asset, whereas gold is not an income generating asset. So when you have interest rates going up because of the inflation to 4.4% levels, people are preferring that I have the steady, and whatever you may say about US's fiscal deficit and all, nobody expects it to default. So you're effectively having a default-free return of 4.4% on the thing. So it's got to flow into dollars. So that's the clear take here. And so the dollar index, as you can see from that sharp V-shaped cover, is now been hovering around the 100 levels. 99.8 to 100.2 has been the level over which it's been there. And this currency strength, I don't put up a slide this time, but if you are from India and you're investing, right, clearly this is something that's a tailwind for the portfolio of the global fund, right? Because this depreciation will reflect straight away in the NAV. So for an investor from an emerging market into the US market, this is a very good thing to happen. And this, in a way, you can say from an India-specific perspective, right, would make FIs a little more nervous about putting money into India. And it's been part of the cause of the pullout, I would say. Though you can also argue that the FI pullout is causing the rupee's weakening, but dollar is strengthening is undoubted. And so we think that that's something that is going to already leading to, in a sense, a flight of capital from emerging markets into the US market, a lot to the bond markets because of the interest rates, but partly also to the US equities because they also carry the tailwind of a strengthening currency, right? So that's something to keep in mind as an investor from the emerging markets and India, right? The next slide is to summarize my summary. This is my last slide, and then Ketul will take over on the valuations part. Is to summarize that March reaction for this asset class. The 10-year treasury served, as already mentioned, to the 4.4% mark, largely as an energy-led inflation premium, right? The dollar rallied significantly on the safe haven demand, so shed all its earlier weakness. The S&P 500 naturally reflected the volatility of the war, and the VIX spiked above 35 as there was a lot of people rushing to hedge portfolios against both the tariff and the war risk. Of course, energy equities are raking in the moolah with the 35% rise in price of gases and oil. So they are the only sector to have generated positive returns during this initial geopolitical shock. So I'll now hand the floor over to Ketul to dig deeper into the valuations and specific the portfolio. And I will hang on here till 12 o'clock for any questions that arise, which we'll take at the end of Ketul's presentation. Over to you, Ketul.
Thank you, Sunil. So now I think Sunil gave a very good overview about the situation on the US macro front based on what happened in March. We will get into now into stock specific items over here, because we want to show that, okay, the bad news is all there, but what's the impact of that on valuation and how lucrative they are. And from the charts that we are going to discuss, you will see that the difference is at a 10-year low. I mean, the valuations that we see over here on the first slide, you'll see Meta. And the Meta's business has not changed much, by the way, because of anything in the last 10 years. It's a bigger company, obviously, so its growth has not slowed down. In fact, it has been consistently growing for the last 10 years. However, if you see the valuation, they are pretty close to the COVID lows. And this is, we are just looking at the next 12 months. If we look at CY27, this chart looks even better. And one thing to remember is Meta is not that impacted from AI or any other, from crude oil prices or anything else that we discuss over here. Meta is not impacted to a larger extent. Obviously, if the entire world economy slows down, then Meta's primary revenues are from advertisements, and that will slow down. But so far, we are not seeing any indication of the entire world economy slowing down. And especially the developed markets where the shock from crude oil is very low, there, which is where Meta gets most of its revenues from, they are not impacted at all. Just to give you an idea about the revenue per user that Meta generates from an emerging market country like, say, India versus US is 10x. So Meta, for example, if it generates about $4 to $5 per user per year in the US, in India, then it generates 10x, about $50 to $60 per user from a US subscriber, or rather a user. So that tells you how unimpacted Meta is when the advertising revenues that they generate, if they are at risk from an emerging market country versus a developed market country. So, and that's the reason we believe that a lot of this decline in valuations that we are seeing are primarily a flight to safety, and people are hedging against the stock markets, but as such, the fundamentals are still strong. Similarly, if you see Nvidia, you will see that it is trading at a historically low valuation. And this is not even compared to the last 2-3 years. This is going back all the way 10 years. And Nvidia became a darling only in 2023, right? As you can see from the chart over there, the PE ratio went all the way to 60-70 in 2023, because that's when AI came along. And Nvidia's change of fortune happened with AI. Before AI, Nvidia was providing GPUs, and GPUs were only used for your graphic processing, which means only your video processing improved with GPUs. Nothing else was using GPUs within your computer. So even at that time, when Nvidia was not at all important to the global ecosystem, to the global compute ecosystem, even at that time, Nvidia was trading at a higher PE multiple than what it is trading today. And today it is almost a monopoly in the compute space for AI. Anywhere you want to do AI compute, Nvidia is 100% a monopoly. There's almost a necessity. There's nobody else that offers the type of compute that Nvidia can offer. And there is a waiting list for procuring Nvidia GPUs. If we place an order today, you might get an Nvidia GPU, if you're lucky, within 6 to 8 months. So with that type of demand, with that type of monopoly, which was not there before 2023, and today it is trading at a lower valuation than what it used to trade in the pre-2023 era, that itself tells you the dislocation in the valuation of some of these stocks. And so that's a very important point. Now, generally we talk about index level valuations, but here we wanted to emphasize that how at each individual company, even though the change in fortune has been significant in the last 2-3 years, and even then they are trading at a much lower valuation than what they were trading in the past when they were not so important to the global economy. And just to give you an idea, another point why NVIDIA is so important, that the US has put ban on some of the chips that it can export to China and other countries, simply because it has become a tool to stop the advance of China in the AI space. So it is that important that US considered or has actually put a ban on exports of its high-end chips, and China cannot produce it. With somebody who is as technologically advanced as China, if they cannot produce it, NVIDIA must be doing something really right, correct? And that's the reason we believe that they will continue to be a monopoly. And in that scenario also, they are trading at a very low PE multiple, at a next 12-month PE multiple of 21, which is extremely low for a stock like NVIDIA. Similarly, you see Microsoft, it's trading at pre-COVID valuations, even lower than the COVID valuations. Similarly, with Amazon, you see that it's trading at a historically low valuations, the lowest in the last 10 years. And so far, the world hasn't found, with AI or without AI, the world hasn't found a better solution than Amazon to deliver something that you need to your home in at the speed at which Amazon delivers. There is no solution right now. So whether we consider it to be a temporary blip or because of the market fears of overall war going on for a longer time, the valuations are certainly reflecting that that these issues could likely linger for a longer time. And if they don't, which is where our view comes in, that if the war doesn't last longer, then these valuations are about, maybe they may last for another 15, 20 days or a month. They are not going to last longer than that, because the reversal, when you see, is massive. Whenever these stocks reverse, they don't give you a chance to get in. They generally reverse within a span of 1 or 2 days only. And that's why we feel that whenever we are getting such a good opportunity, if you have not invested, you should definitely start investing. If you're already invested, you should slowly add to it, simply because you don't get these chances too often. Similarly, if you see Netflix, again, fairly low valuation compared to its history. And again, they are not impacted by the price of crude oil. They are a subscription service. Most of the people, it's almost like a utility. People will maybe stop going to a restaurant to cut their spending. That's the first thing that gets impacted, by the way. Whenever the price of crude oil or any near-term inflation shock hits consumers, what gets hit is restaurant spending. So people stop going to the restaurants as the first cut in their budgets. But they do not cut their Netflix subscriptions, because that is almost like a utility. And even then, the stock price of Netflix has taken a beating, and you can see the valuations have declined significantly. So it is across the board. It's not that some of the stocks have been spared. The valuations have declined and the stocks have sold off across the board, which is where we think that the market should differentiate between somebody that is like a restaurant that is exposed to inflation versus somebody like a Netflix who is not exposed to inflation shocks. There should be a difference in the impact that these stocks have on their valuation. But so far, everybody is sold at an even level. And that's why we feel these stocks are very, very attractive right now. So then let's see, we often get an argument that the valuations just 3 months, 4 months back were at a historic high. While historic high in terms of absolute value is true, but if you see the earnings growth that you see on this chart has kept pace with the valuations. And that is why we feel that even if the valuation, the absolute value of the index is higher, the earnings have kept pace. This is not a liquidity-driven rally. So in some of the markets where you see a liquidity-driven rally, that is a problem. If the absolute value of the index goes up without a commensurate increase in earnings, it's a problem. But with the S&P 500, which is the US large cap index, that is not a problem. The absolute value of the S&P 500 index has gone up in line with the earnings growth, as you can see from this chart. And so periodically they do meet somewhere, and that is what we are seeing that they are meeting right now. So in the worst case scenario, at the index level, this is a fair valuation to invest. In the best case scenario, if it starts going back to its historical trend, this might be the low end of the valuation. Now we see the S&P 500 earnings growth for CY26. So after the war and pre-war, so we have the numbers at the bottom over there from 31st December 2025. That was the estimate for different sectors as well as for the S&P 500. At the very bottom, you will see that the last line in that chart and the fourth bar chart from the left-hand side is the S&P 500. On 31st December, the expectations for CY26 earnings growth were at 15.2%. Right now, after the war, it is at 17.4%. So as of now, the markets, at least the earnings, are not showing any decline for CY26. But the valuations are telling a totally different story. The stock markets are telling a totally different story, which means that there is a dislocation. And this dislocation is because people are shooting first and asking questions later. So the view of the people who are selling right now could be that the earnings will decline. The earnings have not declined so far, but into the future, the earnings will decline. So what is the key over here? The earnings could decline? Absolutely yes. If this war goes on for another 6 months, the earnings will decline. And then some of this selling could be justified. But if the war ends in the next 1 month, then the earnings will not decline and the valuations will catch up again to the earnings. So the key over here, and as most of you are thinking, is that how long is this war? If you think that the war is going to end in the next 1 month, 2 months, then the valuations are very lucrative. If you think that the war is going to go on for the next 1 year, then the earnings will catch up to the valuation, which means the earnings will decline. So that's where, as they say, the rubber meets the road, right? What's going to happen in terms of the war? Is it going to be over in the next 1 or 2 months, or is it going to continue for the next 1 year? And depending on that, either the earnings will decline or the valuations will improve to meet the earnings. And that's where the crux is for this market going forward. I think that's all I had for today. We can talk about AI and the growth and the Capex spend that is going on over there. All these are positives, but I think these positives, the markets are not going to look at it till we get some resolution on the war. So I think I'll leave these slides for the questions. If there are questions on the AI part or on the Capex part, I'm more than happy to go through these slides. But I would like to end again with one last line that we want to emphasize. Your view should be whether the war is going to end in 1 or 2 months or in the next 1 or 2 years. If your view is that the war is going to end in the next 1 or 2 months, then this is an absolute good time to enter, buy, add to your positions in the global stock markets. If your view is that it is going to last for 1 to 2 years, then certainly these valuations and these declines may linger around for some time also, and this may not be the absolute bottom. So that's where we'll pause. Both Sunil and I will take questions over here now. Suman, please go ahead and start with the questions. For the participants in the webinar, please type your questions in the chat box or the Q&A box of the webinar, and Suman will take one question at a time. Suman, please go ahead after you have lined up the questions.
Sure, sir. So first question we can take is like there are a lot of attendees they want to know that this is a good time to increase allocation in US equities or investor should wait for more correction now.
Yes, exactly. As we emphasized, uh, if you think that the war is going to end in the next 1 to 2 months, this is one of the best times in the last 5 to 10 years that you will get to invest in US equities. If you think that the war will carry on for, say, the next 1 year or more, then obviously there is a downside to this also. However, that downside is not much because we saw that action in the last 1 week actually. That so far in the month of March, what we used to see from the beginning of March, which is when the war started, till the last week of March, what we used to see is that stock prices followed an inverse relationship to the price of crude oil, which means every day, and this worked like clockwork, every day the price of crude oil increased, the stock prices would decline, and every day the price of crude oil declined because of an intermediate hope or a tweet that President Trump made, the price of stocks would increase. That relationship broke in the last 2 3 days, where even though the price of crude oil increased by a good 10%, the stock prices did not decline. In fact, they stayed flat or increased actually by 0.5% or so. So that tells me that we may be at the lower end where a lot of bad news is already priced in. So now the stock price decline will not be commensurate with the increase in price of crude oil. So we are getting close to a bottom. So even if this war continues for slightly longer, we may be pretty close to a bottom. You never know what the exact bottom is, but based on the stock price action that we are seeing in the last 1 week, even a 10% increase in crude oil price did not dampen the stock market in the last week, if you see. And that is where we feel you may be getting closer to the bottom, if not at the exact bottom.
So just wanted to add to that, Ketul, because I think the question came from an Indian investor on whether he wants to increase his exposure to the US equities, right? So I'm saying, so I have to put on that hat and say the composition of the US equities in your portfolio and the two scenarios that you painted there of a short war versus a long drawn out war, I would probably say that the long drawn out war, while it's slightly negative for US equities, is even more negative for Indian equities. Because the one they talked about collateral damage in a war, right? What does that mean? It means that the innocent bystanders get killed, like the school children in Iran or whatever, right? India is akin to that. We have no part to play in the war, but we are the single worst affected country because we import 85% of our crude oil requirements, and we are the fastest growing country in the world, which means our imports are also growing at the fastest rate in the world. So war has had a very severe and direct impact for India. I mentioned a 30% increase in gasoline prices. For India, it's been a 55% increase in crude prices. Now, the retail customer has been protected from this by the government absorbing the excise duty and maybe passing it on some to the oil marketing companies. But that's from an inflation perspective. Indian corporates will feel the heat of the increased petrochem prices. The increased cost of crude will translate into urea cost and fertilizer costs, which will affect food production in India. So the danger of a war extending in terms of this, the impact for India is far likely to be far larger than the US. That's number one. The second point is the longer the war lasts, the stronger the dollar is going to be, because this flight for safety will continue to the dollar. So as an Indian investor, I would say either in a short war or in a long war, your exposure to US equities can probably be increased because the currency will come to your aid, right, in terms of the relative portfolio. So if you see that I was looking at the data, we know that RBI did some administrative action against the banks and acted on their NDUF positions, and the rupee has strengthened to 93.1 yesterday. But parallelly, I don't know how many of you have noticed, if you look at the forward premium market, the forward premiums are shot up to 462 basis points, which means almost that 1 year later, the rupee is being projected at 96.80 to 97 by the forward market. So because a sustained oil price increase, its impact will be felt on our trade deficit and on our thing. And you saw from the RBI currency reserves from 700, it's down to $680 billion. On the one hand, if imports are going up and your currency reserves are coming down, then the coverage ratio gets affected. So I don't think RBI is going to be in a very big position to defend a weakening of the rupee. That's why they took these admin actions, because they don't want to dip on the reserves. All I'm saying is that the rupee to me looks to be on a weakening curve over the next 1 year. And so if you take in a 3 or 5% depreciation of the rupee from 90 or 4% from 93 to 97, that's straight away an add-on to your international exposure compared to the Indian exposure. So I would argue that given what's happened with relating to this, it's a good time to increase your allocation to overseas equities compared to Indian equities at this point in time. Because one final point, I know India is not the focus of our conversation today, but the fact is that a lot of people are talking about the correction in Indian valuations. But bear in mind that from an FIS perspective, it's the relative valuations which count. All the other Asian markets have also got hit because their AI dependency is power dependency, and power dependency means oil hurts them. So Asian markets have also declined lockstep with the Indian market. So India's relative valuation hasn't improved significantly for an FI to come back to India and put money into India, right? So all I'm trying to do, to put it in perspective, is that I think that given what Ketul said about the US market, the fact that the earnings are holding up, and the fact that the dollar is strengthening, makes the case for a slight alteration, I would say, in favor of US equities in your current portfolio from an Indian investor's perspective. I mean, for an NRI who's got options and all that, I'm not talking from an Indian investor's perspective.
Thank you, Sunil. I couldn't have said it better. Suman, next question, please.
Sure, sir. We'll move ahead with the second question. That is, currently, do you feel the AI Capex is still in a bubble?
No, AI Capex is not in a bubble, primarily because I think we have some slides over here where you will see these guys are not spending just on spec. On spec means expecting that you will make revenues from it. You see on this slide, their record order books, so their backlogs is at 1.6 trillion. That is the amount of order book that they have ready to generate those revenues as soon as that hyperscaler GPU data centers, when they come online. This is the type of demand that they are seeing. So hyperscalers like Google, Amazon, Microsoft, they are booked for the next 2 years. No matter how many data centers they build, they are going to be utilized. And their order book is 1.6 trillion. So if you have a 1.6 trillion order book, and if you're spending 600 billion on that to fulfill that order book, they are not saying that, okay, we will build this and then we will see if there is demand or not. There is a demand. You have a demand for the next 2 years that you can see. People have signed agreements. And so in that case, if you are building, that's totally fine. And one thing that you have to remember, these capital expenditures can be altered in a short period of time. Okay, so why we feel that this is not a big risk is this is not a 10-year plan that, okay, now you are set for 10 years, you cannot alter it in between. These data center capital expenditures can be changed within a span of 6 to 8 months. So whatever they are spending for the next 6 to 8 months, that is written in stone, that they cannot change anything. But anything beyond that, what they have promised can easily be changed if the demand doesn't come through. And as of now, it doesn't seem like the demand is not coming through. We are seeing massive boost in productivity, massive increase in usage of AI across the board. And so the revenue generation potential of these companies is continuously increasing. In fact, OpenAI, just last Monday, they did an offering. They came to the market valued at about $900 billion. And that's a significant increase from the 100 billion that we saw a few years back, right? And so the demand is not declining. And plus, one thing to remember, which most of the people have not noticed, is that this is becoming a winner-takes-all type of race. Primarily because the amount of money required and the amount of research, R&D expense required to maintain such a model. Because, see, think about it as Google and Yahoo, right? Nobody remembers that Yahoo had a search engine, but 20 years back, Yahoo was a search engine. Now, nobody wants to use the second best. If somebody tells you that, why don't you use a Yahoo search engine? Nobody will use it because everybody wants to use the best search engine. And AI is going to see a similar fate. Nobody wants to use the second best LLM. Everybody will want to use the best LLM. And the proof is in the pudding. So how do we think this is going to happen? Because last week, OpenAI shelved their plans to generate a video LLM. They actually stopped offering that product. And OpenAI is such a growing company, and they stopped offering a video LLM. Means they feel that they are not going to be competitive to Google's and some of the other video LLM providers of the world. So they said that it's not worth spending the money in that direction. So we will stop doing that altogether. Whereas another company like Google can continue spending on that because A, they are the best right now, and B, they have about $250 billion worth of revenue from their advertisements and existing search business. Now, that is a big differential. When you have $250 billion worth of revenues coming in from a business, then to spend money on LLM is not a problem. That's why this is turning out to be a big boys game. No matter how good some of the smaller LLM generators like DeepSeek and all that we saw, they are unlikely to survive because this is not a one-time thing. You have to keep on improving over the next 10 years. It's not a one-year thing. And so somebody who has the talent as well as the resources to continue investing for the next 10 years will eventually win this race. And that's where we feel that some of this Capex is very much required and will see a massive ROI also. So I think given those 2 points, we do feel that there is no bubble on the Capex side. Sunil, you want to add anything?
I'm in agreement with what you said.
Perfect. Suman, we can go on to the next question.
Sure, sure. On the same topic, I have received again a question that how wealth management is likely to be, impacted by AI in India and other major world economies. So, do you think that it will improve alpha potential for clients like retail and HNIs? So it can be, either like market may be more efficient or, there will be a herding bias in the market.
Sunil, you want to start with that?
Sure.
I think that's your core expertise.
Well, yes, the wealth management industry is definitely going to be impacted by AI in India. Other major economies, I don't know, but definitely in India, it's going to, because the customer base is now AI savvy. So forget about your wealth manager himself. Every user of a wealth manager who doesn't use ChatGPT or Gemini today, right? So, and the ability of the customer to then counter check the advisor, right? He'll just ask a simple question to Gemini to say, this is my portfolio. What do you think it's going to be? It's going to throw up a robo-like answer. And he's going to question his fund manager or his wealth advisor on what it does. So there is going to be an evolution of the space. And naturally, AI adoption by the wealth management has to be as fast, if not faster, than the customers adopting to it. So it will lead to what you're saying is that alpha potential of retail HNIs, I'm not so sure. Because what with retail HNI, when you give them more power of analysis, they tend to be trigger happy. See, a lot of investment, the money is made by patience and by doing nothing. Because you picked something with a long-term view and you sit tight. There's a big company which says, no, buy right, sit tight, right? So the point is that speed of action, constantly reviewing the portfolio, using AI to keep updating the latest data will make you more active. It will be more churn, but I'm sure that it's definitely not going to lead to more alpha because situationally, and we have classically, the markets always surprise you with the way they behave. I'll give you a simple example, right? At the beginning of the war, somebody had used AI and said, okay, where sector should I put? AI would have thrown up an answer saying, put it in the tires and the paints and the users because the war will end and then that's when you make your maximum bounce, right? So there'll be pain there, but there'll be gain. And if you want safety, you would have said choose banking because it has nothing to do with oil. What happened? Banking got hurt the worst because there was a sell in India and banking being a big part of the index. So what I'm trying to say is AI, the ability of AI to predict the future versus do a very thorough, fantastic analysis of the past and of the various viewpoints in the world. That's the speed. What AI does is replicative work phenomenally fast and quick, right? Faster than the human brain. But its predictive ability is again a function of what 150 predictions will take and coalesce and give you the most likely prediction, right? It's a machine at the end of the world. Now that will give you, it'll feel that you'll feel empowered to act because you've got this latest hotspot data and you'll go and make a switch in your sector today. But the markets will keep surprising you. And so while it'll improve the feeling of power with investors because they have this AI tool in them and with wealth managers, I'm not sure it's going to deliver alpha. Okay, that's my humble opinion. And you're asking about herding bias and will it make markets more efficient? Absolutely. There's no doubt because all AIs, Gemini versus a ChatGPT versus a Claude, is probably going to throw up the same result. You don't find two AIs disagreeing because they are relying on the database of various influencers and opinion makers and coalescing it and giving it to you. So it will lead to herding bias and yes, markets more efficient, but it's from inefficient markets that you make more alpha. So that actually answers the question you asked about alpha potential, because the more efficient market become, the more alpha evaporates and you're better off with a beta strategy. Okay. So Ketul, you want to add something to that?
No, I think that's perfect. What I'll say in 2 sentences. What AI does, it gets the below average folks to the average level because AI is an average answer. It is putting together a lot of different text that it has read either on the internet or in reports and giving you the average. It will always give you the consensus. It is not going to give you an out of consensus view. And that is where I think you need to be careful about taking answers from AI because it is not thinking. It is collecting information and presenting an answer to you. And that's the big difference. I think if even in terms of writing, if somebody is a below average writer with AI, he or she will immediately become an average writer. But getting above average is very difficult with AI because that's where your own skills, your own creativity, your own views will come into play. So I think that's the difference. Below average folks can get to average, but if you are at average or above average, it will likely improve your productivity. It will not help you in any other way. So that's, I would
in fact, you bring down the above average to the average.
That also could happen if you overuse it. Fair enough. Suman, next question, please.
Sir, so Sunil sir, would you like to take this question? How do you see Indian IT companies getting impacted by AI?
Well, I think that's in a whole session by itself. I will just answer it in maybe 3 sentences. Indian IT companies will be heavily impacted by AI in terms of their business model needing to change from a per person per hour billing to quoting for a project. That's number 1. Number 2 is that I expect them to survive this impending catastrophe of AI by adopting AI within their processes so that their costs of operation come down significantly and they try to protect their margins. So I see that. So it will mean layoffs. So don't read IT sector layoffs as bad for IT industry. IT sector layoffs are the industry making more fitter. It's not good for the India employment story and for the hundreds and thousands of graduates trying to enter IT companies. That's a different issue. But for IT companies, they will become leaner, meaner, hungrier machines. Third aspect for Indian IT companies from this way is that the user industries, the top end, the top $500 billion companies, right, will probably try to incorporate and start off by using AI at their own at the cost of these companies, right, trying to do it. But they'll learn the hard way that it's not easy. But the large proportion of these companies will only need advice from IT companies on managing and adopting AI in their businesses. It's a very subtle point I'm trying to put across. So AI-based consulting will be the next big thing in IT, which will pick up. You've got to give it time. The initial revenues may not be matching, but over a period of time, the IT business model will change where they become AI consultants to consumer industries, to manufacturing, to banks, to everybody, helping them implement AI with their expertise. So that will be a new business model of the IT companies. And the final point is, as a result of this phase, for the short run, till they really become the AI engines of implementing AI in the world, IT, in my mind, has moved from being a growth part of your portfolio to a value part of your portfolio. Why do I say that? Because this business model will take time to change, so their earnings will be steady over the next few years. And as they change their business model, they'll lose that, they'll gain some, but their longer order books will sustain them, number one. And two is, because of the high dividends that they pay out, they will get a new income-seeking institutional investor asset class coming and supporting the shares. So they will become what was before COVID, IT as a more like a utility, steady state earnings, reliable and with a good dividend yield for that set of investors. So this change will naturally come with the pain. A lot of people who had it as a growth part of their portfolio will travel it down, and it will get its place as a value. So I would say that be prepared for that churn. But in the long run, I don't think that. I think they will manage the survival threat and come out winners. But not every IT company will be a winner. It won't be a winner take all to the extreme that Ketul pointed out about AI there, but it will definitely mean that some of the companies won't be able to cope. So diversifying across the IT pool is probably a better bet, rather than saying, I feel this IT company will be the winner. It's hard to predict that. So, and you will also see a lot of M&A activity now happening, because by and large, Indian IT companies have a lot of cash on their balance sheets. So they will try to fast track by buying up medium-sized AI-related companies anywhere in the world and changing them. So be prepared for a lot of action. But like I said, this is my view to summarize it.
So I just want to add one sentence to it. I think he gave a perfect overview that AI, broadly, if you think in terms of what AI does, it is a transfer of wealth from low-end labor to compute. Because what your low-end labor, the coding, the writing that your low-end labor was doing, is now being done by a compute, which is why the value of NVIDIA has shot to where it is, and the value of low-end labor has gone down to where it is. That's what is happening. Anything that a low-end labor was able to do, now a computer can do. And the more the improvement that happens on the computer side, the lesser the requirement of that labor will be. But as Sunil rightly pointed out, the eventual change will happen when the low-end labor shifts to the high-end labor, AI consulting type of projects. And that's where you will see the trend changing again. Now, how and when that happens, I think that is what we need to see over there. Sumant, next question.
Sure. So today, since we have discussed, a lot about US market, so someone would like to know, about the impact on the non-US market. So we have 30% allocation in non-US. So can you share some insights?
Ketul,
Yes.
I need to sign off at 12, so I'll drop off now. You can
Okay,
take.
okay. Thank you, Sunil.
Right. Thanks, everybody. Goodbye. Ketul will take the rest of your questions.
Thank you. Have a nice day. Bye-bye. Yes, so I think on the non-US markets, the impact has been very similar. Because a lot of these non-US markets, like the ones that have been doing well, especially Taiwan, Korea, some of the European countries, they were more because of the same theme of AI. And so they have been hit to the similar levels. Korea, Taiwan, European countries, they have taken a similar beating. And the emerging market countries, they have taken a beating from the increase in crude oil prices because they are the most impacted. And so I think overall the impact has been felt to an equal extent everywhere, some more, some less, but that's just noise. Over a long period of time, that probably goes away. And so we are finding opportunities everywhere. Some of the companies in the space of e-commerce that we invest in outside of the US, they are also trading at a very low valuations, just like Amazon is trading at a very low valuation. And so we do feel the opportunity over there is similar, but the risk over there might be higher. So that's the key point to differentiate over there, that whether the risk is higher or not, right? So if the risk is higher and the valuations have gone down by a similar level, then we would still prefer somewhere where the valuations have gone down, but the risk is lower. So at this point in time, typically flight to safety comes into play. And that's why low valuations in low risk companies is better compared to low valuations in high risk companies. And so I think that's where we are also gravitating towards, that if you're getting low valuations in very good companies, this is the time to invest in some of them. Even within our portfolio, we have added to some of the names which you have never seen in your portfolio in the past. And that is primarily because we saw that we have been following these companies for 2 years and we never got a chance to invest in them because the valuations were too high. And now all of a sudden, because of this market dislocation, you are getting some of these chances where the valuations have become palatable and your view on that company has remained the same. That is more important. That if your view on the company changed and the valuation declined, then it's no good. But some of these companies, our views on the valuation has remained the same, that this is still a great company. It is still going to grow at a very fast pace. This is a temporary dislocation in the valuation because of the overall market scenario. And so then we have a differential view on that company where we feel that the prospects are much better than what it is valued at in the market. And so we have added some of those names to our portfolio in the last 3 weeks, you will see. And if our views work out to be correct, there's a lot of alpha to be made in those companies. I'll pause over there. So my next question.
So there are a lot of questions on AI impact. So mostly we have, like already covered all those topics. So I'd like to skip. There's a last question that I would like to read is, so currently there's an additional question on that impact of AI. So what are the new risks that may, come and investors in AI, AI adoption actually. So are the societies willing to invest to mitigate the risk that may emerge in the, out of the adoption of AI?
That's an interesting point. And AI is moving at such a fast pace that it is very difficult to understand the risks that are coming from AI adoption. And that's a problem. The regulation will definitely not keep up to it because regulators are typically, even in a normal scenario, they are 6 to 12 months behind. In the case of AI, they are probably 2-3 years behind. And the rate at which AI is moving, I don't think anybody will be able to regulate it unless they want to totally shut down their economy to the AI innovations, which nobody would want to do. It is very difficult to regulate AI at this stage because it's moving at such a fast pace. So as of now, we don't see any regulation that will help you mitigate the risks. The risks will come from market-based forces only. So companies like Google, Amazon, Microsoft, they will self-regulate themselves to make sure, because these are trillion-dollar companies, they are bigger than most of the economies themselves in the world. So they have a reputation to defend. They are very cautious about it, and they will make sure that there are no major risks to the economies or the society in general. However, it's very difficult to say if there will be zero risk from the adoption of AI. And that happens with every new technology, be it internet, be it mobile telephony. There are good uses of it and there are bad uses of it. But just because there is a 5% chance or a 5% a bad use case, we cannot, disallow the 95% good use cases. And if you want to think about it generally, in terms of where AI is useful, is that it democratizes access to data analysis and data synthesization. So what the internet did was that it democratized access to information, because what a person in a village in India could access through Google is the same that somebody sitting in New York could access. So it flattened the world in terms of information. I remember when I was growing up, to access any information, we would have to go to a library. If you didn't have a library, you had no option, right? Now with Google, that is flattened. But as time went along, we have had Google for now more than 3 decades. What has happened is that there is an overload of information in the market. Now, with AI, you are able to synthesize that at a very fast pace. People is sitting in New York, they definitely had the option to synthesize that information based on research reports, based on information they get from consulting companies. With AI, it gives you the same capability as an average level of consulting company would give you if you were sitting in New York, right? So now it levels the field in terms of data, not only access, but data collection and synthesization. So that is where it levels the playing field. So it helps the small guys more than the big guys. So I think overall for the society, it's a big positive because it levels the playing field in terms of data synthesization, data analysis, which an average guy on the street would not have. So that's the advantage. And overall, the advantages far outweigh the disadvantages. So I think this is going to continue for some time. Go ahead, Sumit.
So, sir, before closing, can you share your insight on this AI space? So, are you seeing any good companies, coming in this space in India, especially?
In India, there aren't many because see, this is a large Capex based type of an industry where at least in the initial phases, a lot of investment is required to start if an AI model. So as of now, I don't think there are any companies in India that are willing to do that because the risk appetite in India is simply not there. The amount of risk that you need to take and the competition that you have out there is just phenomenal. If you are competing with an industry that is spending $650 billion per year, right? If you are spending $50-100 million in India, that is totally useless. It's not going to get you anywhere in even the top 10 percentile of the competition, right? Just from the amount of money that these guys are throwing at it is just day and night different. You are not even close. And that's why it is very difficult to come up, I would say, in a cheap way, to come up with something that will compete at the global stage. And as I said, this is going to be a winner takes all market. There is not going to be a number 2, 3, 4, 5. It's number 1 or nothing. So to spend that money hoping that you are going to be the number 1 in that space is very difficult. Most of the Indian companies, there may be 1 or 2 that I don't know of. I'm sure there are a few. But at least in the listed space that I'm aware of, there aren't any companies that can have that type of risk appetite. And that's why we feel it is very difficult for any of these companies to compete. Eventually, what happens, we don't know. But as of now, it seems very difficult. Go ahead, Sumit.
So far, we have received all this question. There are some questions that I have already merged because it was quite similar to AI and impacts. So before closing, if you would like to share your statement.
Wonderful. Thank you, everybody, for joining on our webinar today. We have this webinar on the first Saturday of every month at 11 a.m. So we look forward to seeing all of you again in May. Now, thank you very much. Have a nice day. Bye-bye.